I missed a trade because I was at work. I can't trade because I'm not available. I did a great analysis and the market moved in my prediction, but I missed to enter. The market was moving so fast, then I missed to take a trade. What if I give you a solution for those issues? Welcome to the Trading Focus once again. Hope everyone is doing good. In today's video, I'm going to teach you a perfect way of entering in the market when you are not available or the market is moving so fast. That sounds amazing, guys. Subscribe on the channel, like the video and leave the comment below, and we see you in a minute on our today's video. Okay, welcome back. So in the market, whether you are trading forex trading, stock market, futures or indices, we have two orders to place in the market. So those two types are market order and pending order. Okay, so let's start from there. The market order is an order to buy or sell at the best available price in the market. Okay, for example, the market order, this is when you are sitting in the front of your monitor or a PC, a laptop, and you take a trade at available price in the market. Okay, so you sit in front of your computer and then you place an order. We are now on, this is USD, Japanese yen. So we are now on the price of 156. This is an available price in the market. So I will immediately enter from this area, taking a buy from this area, anticipating the price to continue in the upside. So I'm now on my front of me. This is an available price in the market. I'm going immediately to take a trade from this area because I'm available. That is a market order. Okay, so you take a buy from that area, anticipating the price to continue in the upside. Here, we also have an example. If the bid price of Euro USD is currently at the 1.2150 and the ask price is at 1.2152, if you want to buy Euro USD at the market, then it would be sold to you at a price of 1.2252. So you would click a buy on your trading platform, would instantly execute a buy order at exactly price. Okay, so you're in the front of your computer and then an available price that you are going to be taking a buy or a sell based on. Okay, so now what is a pending order? Okay, now a pending order is an order to be executed at a later time at a price you specified. Okay, so that's when you are not available, you will not be available in the market. So at that moment, you take a decision of taking a trade, you place an order in a specified area where you expect the market to reach, and your order will be triggered itself automatically. So the pending order includes other orders, okay? And those orders include the limit order. The limit order is a pending order that we are going to be talking about today. How can we use a limit order? Okay, now let's start from here. So, okay, a limit order. Limit order, remember, is a pending order. This is an order you take at a later time. You set an order where the market is not yet reached. Then after that, the market will be triggered when the price reaches the specified price. A limit order is an order placed to either buy below the market or sell above the market at a certain price. Okay, what does it mean? You know, when the price is moving up, okay, if we have the market moving up, so you are expecting the market to continue in the same direction. So when the market pulls back, that's where you are going to be setting your limit order on the low by expecting the market to reach from this area so that we continue upside, and even from the sellers, you are expecting the market to change the direction to the upside or to continue in the same direction. So on the areas of the pullback, that's where you're going to be setting your sell limit so that the market will be expecting to move in the downside. We are going to be taking examples from the chart on how can we use a limit order on the side of the buyers and the sellers. Okay, buy limit and sell limit. Okay, so this is the current price from this area. So before you enter in the market, this is where the price was from this area. You are expecting the market to be rejecting from this area, so you set your order from this one. It's like a trap. So when the market moves down and hit your order and you're expecting the market to be moving up, that's where you are going to be taking a buy from when you are not available on your computer. So even from the side of the sell limit, the price is moving up from this area. This is a current price. From here, you are expecting to be rejecting from this area so that when the market reaches from this area, you are expecting the market to move downside. So in order for not missing that opportunity, you are not available at that moment, so you are going to be setting a sell limit from this area, and when the price move up and hit your order from this area, that's where you're going to be entering for sale when you are not available on front of your computer or your platform. Okay, let's take an example now from the chart so that we can be confident to use buy limit and sell limit. Okay, so now here we have USD Japanese yen. Okay, so the market is now in the reversal area. We are starting reversing to upside. Okay, so now we have this area which is from the formation of a chart patterns of an inverse head and shoulder. Okay, so as long as we are making an inverse a head and shoulder from this area, this is a neckline which left as a demand area. So the market moved up and retraced from this area by balancing the market, and the market continue up. So where are we going to be waiting for to buy from? I'm not available in the market. I need to use a pending order, and that pending order will be a buy limit. So the areas I'm going to be waiting to buy from is from this one. This is a demand zone. Okay, so now the market is moving up. We are bullish with these candlesticks, so I have to wait until I get the retracement from this area to move back and make a touch from an area where I'm confident that the market will continue in the upside. So at the moment I will not be available, so I need to use a limit order to be buying from this area when I'm not available in the market. Or even another example, if I'm available in the market and even the market is moving so fast, so the time to be entering with that order, I will be missing that order. So that let me just take this idea of setting my order from this area. When the market pulls back from this area, my order will be triggered and execute itself so that I can move with the trend. Okay, so what are we going to do from this area is that we are going to set a buy limit. This yellow line will be stands for a buy limit from this area. The market is moving now. I'm waiting for retracement from this area. I'm not available. I'm going to be setting my buy limit from this area, and so when the market pulls back, I will be executing my order when I'm not available. Okay, so let's see how are we going to be. Let's see how the market is going to be executing itself and continuing the upside. So you enter like this, and remember, when the market does not reach from this area, I will not take a trade. Okay, so now I will be entering from that area, anticipating the price to continue moving up. my target will be at least from this area. So remember, I will not be available. I'm setting this so when the market pulls back and make a retracement from my area, the price will be triggered itself and continue in the upside. Remember, this is my order from this area, at least from this. So the stop loss have to be below this area. So let's see what happened. Okay, the price pulls back and my order has been triggered with this bullish candle, which has moved down before we start moving up. So now that's how the market is going to be triggering your order and execute itself so that you can enter in the market when you are not available. So let's see if the market will continue upside. Okay, we are still moving up from that area. So now we are pulling back slow. This also will be an entry to be setting a buy limit. So let's see if we can continue until we get to our target. Okay, so remember, we are not available in the market. Okay, now we go to our target with an amazing strategy by entering in the market when we are not available. Okay, so that is from the side of buy limit. Okay, remember, as long as the market is, for example, also again, the market is moving down by making lower and lower highs. Okay, so you are expecting the market. Okay, let's do like this, moving up. Okay, we come back in the downside also from this area. So this is what I'm gonna do. In the market, the history repeat itself. So I'm expecting the market to be rejecting from this area. Okay, we are now moving down. So what am I gonna do from this area is that I'm going to be setting my buy limit by expecting the market to be reversing from this area and start moving upside. So I will set my buy limit from this area. Then when the market keep moving down and hit on my order, I will be able to enter the market when I'm not available. So that's how you set a buy limit, by anticipating the price to move in the upside. So remember, you buy when the market is moving down. Okay, so that's how we use a buy limit. Okay, let's now move to the sell limit. Okay, so how is sell limit will be doing? So the market is moving up by making higher highs and higher lows. Okay, we are expecting the market to be rejecting from some areas and start making a reversal to the downside. Okay, so let's say we have this area from upside. This area is strong, so I'm expecting the market to be rejecting from this area and start the downside reversal. Okay, so now I will be setting my sell limit from this area. So when the price reaches that area, my order will be execute itself and continue with the trend. Okay, that is the way of using a sell limit order. Also, another way to be using a sell limit order is in the trend continuation. Okay, let's say the market is moving down, making lower and lower highs. Okay, so in the retracement, okay, so let's say you are expecting the market to be making a retracement from this area. So let's say in general this area, so you're expecting the market to be pulling back and make a retracement from this area. So I'm going to be setting my sell limit. Okay, that is going to be your sell limit. Okay, this is a sell limit order. So I'm expecting the market to make a pullback from this area. So I will be continuing in the market. I'm not available. I'm expecting the market to pull back from this area so that I can enter in the market when I'm not available. That is the simple way of explaining the sell limit order. Okay, on the side also, on the buy limit order in the trend continuation. So let's say the market is moving up by making higher highs and higher lows. Okay, you're expecting the market to make a pullback from the areas you're anticipating the market to be pulling back and continue in the upside. So you are going to be setting a buy limit from this area, buy limit. So if the market pulls back from this area and hit on your order, you will be able to be entering in the market when you are not available, and your trade will be executed itself and continue in the upside. So that's how we use buy limit in the trend continuation. Okay, let's take a look on example from the chart on the sell limit. Okay, now this is Euro USD. So we are in the downtrend. Okay, the price is moving down from this area. Okay, so now we are expecting the market to continue in the same direction. So now we are not available. We are going to be setting our pending order, which will be a sell limit. So where are we going to be setting our sell limit? So let's start from this area. Okay, this is an area where we are going to be setting a sell stop. So when the market moves back and retraces from this area, that's where we are going to be taking a sell from. So I'm expecting the market to make a pullback and balance from this area so that we can continue in the downside. Okay, so now we set our sell limit from that area, taking a short from this area. Okay, the stop loss will be above from that area, anticipating the price to continue downside. So then when you are not available and the market pulls back and hit your order, that's where you're going to be entering from by taking a sell when you are not available in the market. Okay, let's see what happened. Our order has been executed itself, so that let's see if we can continue moving down. Even all of these ones are also sell limit. So we continue down and we get to our target. So guys, that is the way of using a buy limit and sell limit. Remember, you buy from the low and you sell from the high. So you buy when the price is moving down, and even you sell when the price is moving up. So you set your order with, for example, you set an order of buy limit when the price is moving down and you're expecting the market to be rejecting or reversing from an area where you're expecting the market to move up. So you set a sell limit when the price is moving up, and when you're expecting the market to be rejecting or make a retracement from an area which is above to move to the downside, that's where you're going to be setting your sell limit. And when the market hit your order and continue in your prediction direction of selling trend, that's where you are going to be entering in the market when you are not available. So guys, entering in the market with limit order needs a confidence. A confidence comes from experience. Experience comes from things you see over and over again. So as long as you back test, you are going to get confidence to be taking a trade because you have an experience. So start from today by back testing and using this strategy on the side on demo account, and even back test. As you get confidence, you are going to get better and better, and you won't miss trades when you are not available in the market. So guys, thank you so much for watching. Until next time, take care and be safe.